right, thanks for coming. This is our Should Your Bank Be Using Cryptocurrency panel. We've got some panelists here on a couple different sides of the cryptocurrency opinion. We've got some pro-crypto, anti-crypto, and then they're all technologists in their own degrees. So the thing about crypto is it's become really topical lately. Recently, in the last couple of months, there have been some high-profile news stories about crypto, whether it's a new large bank adopting the use of cryptocurrency for asset-backed lending, or they're now bringing it into some sort of transaction system, all the way to the other side of an exchange blowing up and leaving thousands and thousands of people out to dry. We're going to be exploring these topics. We're going to be exploring some sort of the regulatory side of crypto as well. And yeah, I think that's all I need to do. So I'll introduce myself. My name is Andrew Pigmanelli. I run a company called Velvet. We are in the private finance space. We help investment funds raise money online. We deal with a large number of cryptocurrency hedge funds, private equity, venture capital funds. We also deal with a lot of traditional finance vehicles as well. I'll be moderating the panel here today, so this is probably the most you'll hear from me. But yeah, and I'll let our panelists introduce themselves. George?
I'm George Sutton. I'm here because hopefully I can bring some regulatory information to this topic. And as I've tried to get educated about it, the regulatory side of it is really what is missing from the equation now. And I'll cut to the chase. And with apologies to Nash, my take is when regulation kicks in, there is no future at all in cryptocurrency. Again, I started out as the commissioner of financial institutions in Utah. I was the lead regulator. After that, I left and as an attorney began working on new bank applications. Utah, by the way, is a banking center for those who are not aware of that yet. In terms of total assets under state supervision, Utah ranks 5th in the nation. So it's a major undertaking to regulate these banks. We've had a lot of adventures. When I joined the department, we had some private deposit insurance funds that I learned an awful lot from regulating those. To give hopefully the regulatory perspective on this and to talk about also how I think the simple economics just make cryptocurrency a non-starter.
I'm Jackson Walker. I am an associate at Wilson Sonsini. I am a securities litigator, and I've also worked with DOJ investigations for antitrust and fraud. And I personally am involved in some crypto projects, mining, and but also from a regulatory standpoint, understanding that landscape or a lack of regulations from SEC or moves from Washington on that regulation. I think I come to a different conclusion than George on whether regulation would make crypto a non-starter. I also think it's important to differentiate between the different types of cryptocurrencies, as they're not all created equal. And I think there are plenty of institutional investors waiting on the sidelines, ready for regulation. And then once there is some regulation in the space, that it could actually propel crypto forward.
Hey, my name is Nash Foster. I'm the CEO of a Layer 1 crypto project called Silvermint that will be launching next year. I run the software company that designed and built the consensus algorithm that underlies it. We are hoping to make Silvermint a blockchain cryptocurrency that will support actual end user commerce, that'll be fast enough to compete with payment systems like Visa and cheap enough that people will prefer to use it over existing payment rails. So we think that cryptocurrency is the future of finance, and that going back to sort of what the moderator sort of led with, I think if banks want to be relevant in 15 or 20 years, then they need to start exploring the ways that they can use cryptocurrency today.
Thank you. So the format for the panel is going to be, I will just talk about a topic very briefly, and then we'll open it up for opinions. Whoever has the first response can go there, and then we'll move the discussion on from that point forward. So I'd like to start off with adoption and the things that banks are doing now. I mean, there's a big contrast between smaller banks and larger banks in terms of adopting new technologies. Sometimes smaller banks adopt more quickly, and sometimes larger banks adopt first. With crypto, it seems like the larger banks have led the charge on this, with Goldman Sachs opening cryptocurrency accounts. Most recently, BlackRock has started to get involved. And then in California, Silvergate Bank has been involved in a lot of cryptocurrency projects, including backed lending. What do our panelists think about the adoption going on, and do you think that's responsible? Do you think banks should be adopting existing cryptocurrencies, or do you think they should be pushing back against them and waiting for the regulations to come out?
Well, let me start. Until recently, I was on a board of directors of a bank. And of course, we were constantly looking at what technologies were developing, which ones we needed to track, which ones we needed to stay away from, which ones had some real promise, but were not ready for prime time. About a year ago, I voted along with the rest of the directors to move a big chunk of our technology into the cloud. And what we're doing is bringing in consultants who can educate us on this, that know what they're talking about, that can describe the safety of these systems, the benefits of these systems. There is a lot of stuff going on in the technology world that touches on that, and the boards are looking at that all the time. But we also looked at crypto. You hear a lot about it. We started asking, what is this stuff? When we finally got educated on it, there was nothing for us to vote on. My opinion, and I'm sure it was shared by everyone else on that board, was we didn't want to get anywhere near this stuff. It is snake oil. It is inherently a scam. It would be like knowingly banking people who are running Ponzi schemes. So let's talk about why that's the case. Look at the regulatory world. There's a whole spectrum here. On one side is stuff that isn't regulated at all. Non-bank commercial lending is not regulated. It doesn't need to be regulated. Next to that is commodities. And essentially the commodities regulators go into that space and make sure that the exchanges work properly and the trades settle and that sort of thing. Next space is securities, and that's regulated to require full disclosure of the risks and the nature of the products that you're investing in, and again, that the exchanges work fine. Then finally, on the other end of that spectrum is the banking world, and you have a whole array of separate regulators there, and they regulate the banking system and the monetary system. The problem we've got right now is that cryptocurrency, which is kind of dressing it up, it's really crypto money, isn't money. It's regulated as a commodity. It's represented to people as being money, and it is not. It's not useful as money unless you're a criminal. The criminals love this stuff because they can make payments, and it's never traced. But you can't take Bitcoin and use it as a form of money right now. So what it really is an investment. So all of this activity that Andrew is referring to is primarily happening in the larger banks on the investment side. So some of those banks are saying, we will custody crypto tokens for you if that's what you want us to do. And they are probably looking at other things. I know Fidelity Investments, but here's a very good example of this stuff. Fidelity Investments just came out with a mutual fund that invests in cryptocurrencies and put that out to the retirement fund administrators if they want to have some of that as part of their stuff. The Labor Department jumped in immediately and said, you have a fiduciary duty to the beneficiaries, and if you get into crypto, you probably have violated that duty. The reasons why, it cannot really function as money. Real money, store of value and a measure of value. And it needs to be stable, and it needs to be supported by a broad contract. That works for dollars. There is no cryptocurrency that comes close to meeting those standards. Among other things, the volatility. You know, last November, Bitcoin, and again, as a measure of value, think about this. Bitcoin is measured in dollars. So last November, Bitcoin was $60,000 per coin. Then it dropped by 50%. Then it jumped back up by 50%. Then it dropped by 70%. Today, it's at 70%. If Bitcoin was...
No, today it's at $25,000.
Okay, at 25,000.
Yeah, and if you bought Bitcoin 5 years ago, your return on investment today, even after losing 60% of its value, would be 480%. Over the same period, the S&P 500 did 60%.
But you cannot,
Okay? To say that Bitcoin's not a store of value is to ignore the entire history of Bitcoin and its asset appreciation, specifically because there's demand for it and people are actually using it to transact with each other.
But if you're managing the money supply, if Bitcoin was the primary currency of the United States, we would have had 70%.
Nobody's arguing for Bitcoin to become the primary currency of the United States.
We would have had 70% inflation in the last 9 months. What does that equate to?
So what did we get, 35% instead? Right?
No, not getting to that. And we have a government that is working on controlling that. That the volatility makes it ineligible to function as money. And the volatility is built in to the markets where it's traded because that's where the profits are. The volatility is that you have a little bit of software that has no value in itself. So the people who are making the markets in this stuff bid the prices up, sell out, let the prices crash, buy back in, and go through the cycle again and again. That's where the prices are. You cannot bring it back to stability as long as it's primarily an investment device, and that's what it is.
I think you have to be able to see if I don't think volatility of any fiat currency or a cryptocurrency is a determining factor of whether something is a commodity or not. If you were to look at other nations and their currencies, they're less volatile. So if you were to look historically in Venezuela, in the Bolivar, like their cryptocurrency became very popular in Venezuela in the use of Dash because the government continued to print money for their own uses, which sounds very familiar currently, and then they would receive, most people would get paid in the fiat currency of Venezuela, and they would exchange it for Dash. And it became so popular that the top 5 pharmacies in the country would accept that as a currency and exchange it. And the same can be said with Bitcoin, that Bitcoin has been said that it's a commodity under securities law, and under the SEC has already said that it is a commodity. Because for it to be a security, to be in that regulation, it has to pass the Howey test, right? And the Howey test, it's nearly 80 years old, which is it's a court case where it determines what is a commodity or what is a security. And whether investment contracts, and we're talking about these investments in cryptocurrencies, and if those investments are a security, then there are certain regulations that these cryptocurrencies or these projects need to comply with when they have initial coin offerings, similar to IPOs, of disclosing to the public all of the risks and all of those factors, which, to George's point, is correct, they haven't. Most projects have not disclosed those things, but some of them have. Some of them disclose those things in white papers, but Bitcoin, the test for the Howey test is 4 parts, that it would be an investment of money with the expectation of profits through the efforts of another or others that is not themselves. So with most of these cryptocurrencies, if it is an investment in some other project and you expect that it will grow because of the efforts of someone else other than just the public at large, then it's going to be seen as a security eventually, I imagine, by the SEC. But Bitcoin is different because who created Bitcoin?
So let's talk about
an individual.
Let's talk about oversight for a second. One of the things that cryptocurrencies have been used for is when individuals can't necessarily get a bank account or shouldn't necessarily have a bank account in their country's currency. A great example was people walking out of Russia in February, memorizing crypto codes and their private keys, and then taking their money out of the country when they weren't allowed to do so under traditional financial means. An example in the United States could be somebody who maybe can't open a bank account for one reason or another. Maybe they're an immigrant, maybe they have overdrafted too many times or something like that. Accounts where there's absolutely no oversight and no regulations have advantages and disadvantages. Could we talk about that for a minute?
I mean, the largest segment of unbanked in the United States is illegal immigrants. And they are one of the largest sources of revenue for financial institutions as a result of illegal immigrants being unbanked is fees on remittances back to their home countries. Western Union, I think, charges something like 10 to 12% of a remittance, in terms of fees on one of those payments. And so a lot of these people are now turning to cryptocurrency because fee structures make a lot more sense when you're getting charged 1.5% by your exchange, and you can make payments and remit payments that way. It makes a lot more sense for these kinds of people to use cryptocurrency. So this is an example of one of the advantages that, for that segment of end users. Obviously, George is going to argue that they're all criminals, and it's a complete snake oil scam. But I think the point is that there are a lot of people in the world. Most people in the world don't live in the United States and aren't subject to our regulations. But they're people that we want to have economic relationships with, right? The United States has been a significant force for economic globalization over the last century, and I think that's generally viewed as a net positive. If we can't transact with these people because our regulatory environment is too stifling, then I think people are just going to look for other solutions that are managed in other countries, and they're going to use those instead. So I think, frankly, that talking about more regulation in the financial industry is really the wrong direction. The regulatory environment needs to loosen significantly, and it needs to loosen in a way that's going to allow innovation by people who can actually, find use cases that are reasonable. I'll give you another example. We just had a meeting last week with a company that's they're a non-financial institution, but they're basically processing payments, and they are targeting the multi-level marketing industry, which is huge in Utah because it's not regulated here. They're expecting to onboard 10 million users in the next 9 months. The reason that the MLMs want to use crypto is that they struggle to maintain banking relationships because of the regulatory overhead. Banks will just randomly show up and say, listen, you guys added 75,000 accounts in Brazil, and that means that you're over our regulatory threshold and you can no longer be a customer here. And you have to move your financial, your bank account somewhere else. So crypto solves that problem for MLMs that are currently using prepaid cards or what have you to make international payments. So I think there are a huge number of use cases, and I think regulation in the United States is merely going to stand in the way of legitimate innovation.
Well, let's look at some of the impacts of not being adequately regulated. And this stuff is not adequately regulated. It's regulated as a commodity, not as money. And money needs to be regulated as money. This is a verbatim quote from a statement that was issued, a report issued by the Federal Trade Commission last June. Since the start of 2021, more than 46,000 people have received over $1 billion in crypto. That's about 1 out of every $4 reported lost, more than any other payment method. 575 million of all crypto fraud losses reported to the FTC were about bogus investment opportunities, far more than any other type. This whole area is just infested with crime. Paul Krugman points out they're only talking about the fraudulent activities that happen. The US government just shut down something called the Tornado Cash Exchange for laundering $7 billion, including money for North Korean hackers who are converting that money to support the nuclear program in North Korea. Crime is just rampant there. Celsius Networks, which billed itself as a crypto bank. It did everything a bank did, but using crypto money. But because that was a commodity, it was over in the commodity space, and the commodity itself was not regulated. It was paying 18% interest on crypto deposits. Because it was paying so much, it attracted 1.7 million users. And recently, and it was constantly, in fact, I bought 2 t-shirts. I was really going to take a cheap shot and wear one of these t-shirts to the panel today. It would say, unbank yourself. And the other one says, banks are not your friend. Well, this guy kept hyping it and kept saying, we are safer than any traditional bank. Bring your money here. Well, they just filed bankruptcy. Those 1.7 million people have no access to their mone. And
How many customers did Bear Stearns have when they filed bankruptcy?
We're talking about.
It's not like the traditional finance industry isn't rife with crime too.
No, let me go back to my days as a regulator. In fact, let's go back further than that. This is why it is so fundamental to the economy. Deposit insurance. At the depths of the Great Depression, the worst thing that happened was a panic set in across the nation. There were runs on all the banks. The runs were killing even the healthy banks. His second week in office, Franklin Roosevelt had to declare a bank holiday. He closed every bank in the nation. A couple of days later, Congress passed the Federal Deposit Insurance Act, created deposit insurance, the runs stopped. That was the turning point. That is what made it possible for payments to begin to flow again and for us to start to get out of the Depression. When I was the commissioner, we had a private insurance fund for credit unions. It turned out that that fund insured 1/3 of all the personal checking accounts in the state, and it was insolvent. And we were looking at literally having to freeze all of those accounts while the credit unions converted over, hopefully, to federal deposit insurance. Instead, we went to the federal deposit insurer, struck a deal with them, made an overnight conversion of all of these, and that whole thing, which would have been an economic disaster for the state, turned out to be the 3rd or 4th story on the evening news that evening. That's how fundamentally important deposit insurance is. There is no deposit insurance for crypto money, and there never will be because of the lack of regulation, because of the lack of controls in that space. The other big problem.
Do you think that it is something that regulators can't come up with, any regulation or requirements to back it?
It's only insurance, and insurance is an oxymoron unless the federal government backs it. Deposit insurance is an oxymoron. I have dealt with institutions that failed, like Celsius Networks, and left the people without access to their money. This stuff is a disaster. There is no rational argument that could be made for getting rid of that safety net. If it's going to be money in an advanced economy, it has to be stable, it has to be insured, it has to be protected. Nobody but the federal government can properly issue money. Think about another thing, managing the money supply. The federal government brings stability to the entire economy by managing the money supply. You can't do that.
The federal government does not manage the money supply. The Federal Reserve does, and that's a private bank.
That's not true. Congress, let's take the pandemic we have. The pandemic kicked in. We go into a lockdown. Businesses close. People become unemployed. Congress passes an appropriations bill. It funds unemployment insurance. It funds the PPL programs that the bank I was on. We did a few $1 billion of those loans. It kept the money flowing. The whole point of managing the stability of the economy is that you have to keep a balance between demand and supply. Cryptocurrency is totally divorced from that process. You couldn't create enough Bitcoin, first of all, to run the US economy. And secondly, in a downturn, you couldn't create a lot of it. And there's no mechanism to get a lot of it into the economy.
The monetary policy of Bitcoin is specifically designed to prevent it from being managed. There's a fixed number of Bitcoin that will be mined, though no more will ever be mined beyond that number. And there's no central organization that has the ability to change that number or modify it in any way. And that's considered a desirable trait, specifically because people are tired of watching federal governments, whether it's here or in Venezuela or in Zimbabwe or wherever else, right, print up money out of thin air, right, and devalue what monetary assets people are sitting on. You may say that the FDIC insurance is critical to the economy, and in the 20s that might have been true, right? But today, during the pandemic, we watched the federal government basically triple the money supply, right, or the Federal Reserve triple the money supply over the span of a year, right, which is now causing massive inflation, right? This is not something people love. Right? They want to be able to put their, and this is one of the reasons why most people don't keep their wealth in money, right? They keep it in real estate, they keep it in, so much money is stored in watches now that Rolex, you can't even buy a new Rolex, right? Rolex is backlogged for 25 years, right? That's where people are putting their wealth, right? Is in assets, right? They're not putting their wealth in FDIC insured savings accounts. That's not happening. And in the last talk you saw, right, they were talking about balance sheet leakage, which is basically financial institutions losing on balance sheet cash to other businesses that are more interesting to end users right now because the appeal of storing your money in a bank is declining compared to the appeal of storing your money in a financial tech company that has greater utility than banks for payments or cryptocurrency or any number of other solutions.
Speaking of government money supplies, there have been some chatters over the last year or so about a central bank digital currency being something the federal government explores. What are your opinions on that? Should it be done? Is it something that could be productive, or is it something that would be reductive and actually decrease?
The US dollar is already a central bank digital currency. Like most people, I would venture to guess that relatively few people in this room have more than $100 in their wallet, right? But everybody here has multiple credit cards, right? The dollar is already a digital currency. What the Fed means when they talk about CBDC is they want every American to have an account at the Federal Reserve, right? And they want to be able to, yes, this is what the Federal Reserve CBDC proposal is, believe it or not. They want every American to have an account at the Federal Reserve, and they want to be able to control those accounts. For example, if for some reason they believe that you're violating AML, they'll freeze your assets, right? The U.S. government CBDC proposal is horrific. It's terrifying, right? It's essentially an attempt by the federal government to take complete control of the financial system so that they can then implement Chinese-style totalitarian control over people's financial lives.
Come on.
It is. Read the proposal.
So do you think that type of control is not already available to the government with traditional bank accounts?
I mean, they're working on it, right? This is a big part of what the Patriot Act was about, was implementing KYC, AML type stuff that allows the federal government to freeze assets for whatever reason they want. They don't have complete control today, no. I don't think, that's the case, but every year that goes by, they exert more and more influence because that's what governments tend to do.
But the trade-off is if you go over to a cryptocurrency and the government is not involved in that, again, you don't have a mechanism to balance demand and
Let's just be
supply.
clear, nobody in the crypto space is arguing that the Bitcoin should replace the dollar or the ruble or the yen or any other fiat currency. What we're arguing is that cryptocurrency has a place in the financial world, that blockchain has a place in the financial world, that we can build assets like various kinds of derivatives using smart contracts on networks like Ethereum that are interesting, they're more efficient. That's not a replacement for the dollar, right? It's any more than the euro is a replacement for the dollar. So I think, arguing against that straw man is not helpful. What these guys want to know banks do and how should they engage with crypto? And the answer is, I mean, you were right earlier, like many projects in the crypto space are not money, they're investments, right? And so, for example, you create a smart contract where on one side you have people who want to invest and make loans, people who want to receive loans. And you can imagine that banks might be on the investing side, that they might want to pool their money with tens of thousands or millions of people in order to provide liquidity for loan making at rates that are more attractive than what they would get in the normal retail side. That's a totally sensible, completely reasonable thing to do with the blockchain. It's not snake oil, it's not a scam, it's just a derivative like any other derivative in the financial industry.
Well, I think that's what we're waiting for, is to see some of those systems finally become mainstream and really be proven. If you had something that was safe and didn't displace the dollar, it's the displacement of the dollar.
Nobody's talking about displacing the dollar.
Oh, a lot of people are talking about that I've read.
Most of cryptocurrencies are tethered in some way to the dollar and deriving their value within a market.
So do you think banks should adopt cryptocurrencies that are tethered to US dollars? They're called stable coins. Do you think banks should look into using those or accepting deposits in those? What are your thoughts?
Algorithmic stablecoins are very
Isn't that just printing more money by somebody other than the government? I mean, if you're concerned about like printing money, I just want to throw something out here for the benefit of everybody too. Like the reason that, like George is right on like there not being insurance. Like if you can insure one of these products, it would go a long way towards making it somehow viable. But the problem is there's no way to peg the value of it to anything because it's not backed by an economy. I mean, the reason that the dollar works and the euro works is because you've got the GDP of the United States or the GDP of Europe that are behind what its value is. So you're basically valuing the efforts of a nation over time. And yeah, you can create more supply and thus lower the value of an individual dollar by printing up some money, but assuming the government has some sense, it will try to manage that in a way that we don't tank the economy. But if private companies start printing cash and it's tied to the dollar, like that's just
actually there's a really good example.
It just seems like
there's a really good
to me, like with no actual value to back it up, and because there's no actual value to back it up, like some percent, infinitesimal percent of the United States GDP behind a dollar, how can you possibly insure it?
So I guess to go back to the question, I just want to sort of give a little bit of tech background. There's two different kinds of stable coins in the crypto space. There's fully backed stable coins like USDC, and there is what are called algorithmic stable coins, which are not backed by anything. In the case of algorithmic stable coins, you're 100% correct. It is a private company printing money out of thin air and then selling it to people. And I will be the first to say algorithmic stablecoins are incredibly dangerous. George Soros proved that not even the Bank of England can maintain a currency peg if investors want to work hard enough to break it. And algorithmic stablecoins are no different. They're just more complicated and people don't understand them. But Circle actually keeps $1 in reserve for every token it issues. Right? And they earn their revenue and make their money on basically, the differential bond rates of very stable investments that they make with those reserves. And so everybody that has a USDC token knows that there's $1 to go with it. And in that case, it's not inflationary. They're not printing dollars. They're merely making dollars visible on a payment network that's not the Federal Reserve's payment network. And that's exactly the same thing that Venmo does and PayPal and any other fintech payment platform, right? And in that case, I think, yeah, those kinds of stable coins are going to become increasingly important as end users adopt cryptocurrency.
There are other crypto projects that are backed by gold, and they have those as reserves, or even oil or natural gas, and none of those coins mint until there is a amount of oil sold or drilled, and they have rights to those within those projects. And so similar to how for oil, for example, the dollar used to be the currency of choice for oil, but lately that is in question based off of the uncertainty of the US dollar and the inflation that's happened with the US dollar. And so there is a lack of confidence in the US currency that we have. Even globally, there's lack of confidence in the dollar.
But if you have a stable coin that is that is collateralized with the dollar, why have the stable coin? Why layer another kind of currency over currency?
Because it allows you to participate in a different set of financial technologies, right? I can't put dollars directly into smart contracts on the Ethereum network, but I can put USDC into it. And so what I need to do is if I want to invest in some instrument that's effectively some kind of smart contract oriented derivative, I want to invest in it. I've got to convert my dollars to USDC, then I put my USDC into the smart contract, and now I've made my investment.
Why?
And when I want to take my profits, I take them out as USDC, convert back to US dollars, and pay my rent.
Why can't you put US dollars into those contracts?
Because the US dollar is a fiat currency it's not shown on a blockchain network, which is needed from a technological standpoint. There has to be a blockchain network something has to represent those dollars. So in a smart contract, say the first smart contract, a vending machine, right? You put in $1 and then you say, I want that thing, and then you press certain buttons and you complete that, and then a machine gives you the thing that you wanted for $1. But that dollar became a representation, and you saw on the screen $1, but it could have said 1 token at the vending machine. You have 1 token, and it's worth 1 token. And now it comes out. And you didn't deal with any human entity. So that's the very beginning of smart contracting.
An entity like Circle or Tether, for example, that does this one-to-one backing, sounds very similar to a bank. It's a centralized entity that does this, basically taking deposits and issuing reserves. Should that be regulated like a bank? Should it not be regulated by a bank, and why?
As a regulator, I got to tell you, I do not see any way to drive the crime and the instability out of that market unless you regulate it like a bank. You can't regulate money like a commodity and expect it to perform like money. Let me give you another example. Consider all of this volatility. If you're lending money, you cannot lend money unless you know the value of the currency that will be used to repay you. If I lend somebody last November 1 Bitcoin valued at $68,000, I think it got up to about that level, and they pay me back today with 1 Bitcoin that is worth $24,000, I'm out of business. I have lost 2/3 of my principal, meaning the purchasing power of the currency. If cryptocurrency, and Nash, you were talking about 60% of the entire market being taken over by cryptocurrency, it eliminates credit. Credit drives the United States economy today. If you end credit, we shrink to a tiny fraction, and that is going to be an economic catastrophe. That's why the policymakers in Washington are saying this stuff cannot be allowed to happen. If we want a stable economy and relatively...
Are they saying that? I don't think they've been saying much. I mean,
Not on the record.
No, they haven't created any regulations.
Well,
they haven't taken a step forward.
Well,
We've been waiting on the SEC to do something other than say that Bitcoin is a commodity. Ethereum may be a commodity. We're going to back away from that. The merge is happening now. It is looking more like a security, but they haven't. They speculated and they've had some regulation in the area, but other countries like Singapore they've stepped up and they've actually created some regulations and created some certainty. So there are plenty of crypto projects and money going to those other nations where they know what's going to happen. It's predictable. A lot of regulators, they haven't been doing their jobs. They haven't moved forward.
Well, I think that hasn't been addressed yet. It's certainly being studied now, but I think it hasn't been addressed yet because investing in crypto money, and it's just an investment at this point, is out here on the fringe. It's not happening in the mainstream of the US economy.
What are you talking about? Coinbase has more users than Charles Schwab, right? How much more mainstream do you want it to be? Right? There was a time when I first got into the crypto space and I would talk to young people, you know, and meet them around town or whatever, and I would ask them if they knew what Bitcoin was. And now I don't bother asking them if they know. I ask them which cryptos they own, because they all own it, right? There hardly anyone under 30 doesn't own a little bit of crypto, right? Like, so it may not be mainstream for guys like you, right? But it's mainstream for the next generation of end users that all of these bankers are going to have to appeal to if they want to stay relevant in, 2050, right? When old guys with white hair like you and me are going to be gone. So, I get what you're saying. Like the thing that's difficult, one of the things that's really difficult about cryptocurrencies is it's so diverse, right? It's like the financial industry as a whole. So things like Bitcoin are similar, analogous to fiat currencies. They have different monetary policy. Their transaction security is supplied in a different way through a technological mechanism instead of through a regulatory mechanism. And that creates some issues, and there's some stuff to talk about there. But there's an entire huge market for products that are not like BTC, that are swap contracts, that are options on things like commodities, right? That are tied to other foreign currencies or what have you. And just as the financial industry as a whole has a massively diverse set of products that are made available to people, the cryptocurrency space is doing the same thing, but we're doing it with a different kind of technology than what you guys are used to. And I know that makes it confusing, and it's difficult to fit it into the box that regulators and bankers are used to thinking inside of. But I promise you that it's mainstream already, and it's not going anywhere. Like, the US can clamp down on it as much as they like. The rest of the world is going to use cryptocurrency whether we like it or not, right? So if we want to participate in the world economy, like, being regressive about this is not the right approach. We need to become sufficiently educated about what kinds of assets exist in the crypto space, what the risks associated with them are, right? So that bankers like you guys can make sound decisions about whether or not to participate in this project versus that project, just like you make the same kind of decision about whether or not to participate in, to invest in one kind of existing financial instrument versus something else, right? And that's the name of the game, is like, we have to manage risk. And in order to manage risk, we have to understand it.
But I think to understand it, that regulators need to require these ICOs to have public disclosures.
They already, so just for what it's
For
worth,
some of them,
if an ICO is a security under the Howey test, it is subject to all the same rules as any other securities offering.
Just because there haven't been other regulations, there still are laws in place that do protect some investors, but I think I do understand that from an institutional standpoint, banks or even Fidelity would be weary in investing other people's money who they have fiduciary their duty to in cryptocurrencies with a lack of clear rules and regulations from government agencies or institutions. And we've been missing that. And I don't think that once they're regulated, that's going to lead to cryptocurrency disappearing. I think that will lead to cryptocurrency being something that these institutional investors, they want to get involved into a lot of these cryptocurrencies. And again, it's not every cryptocurrency, but some of them. And they're gonna want to invest in that. And you're gonna see cryptocurrency, I think, as a market will grow.
Well, I think you're hitting on a key point here, because we keep kind of jumping back and forth between the development world and the scamsters world. And I think one of the challenges for the crypto world is to figure out, you've got to get rid of all this criminal stuff. You've got to get rid of
Hey man, look in a mirror. Everybody watched the banks steal trillions of dollars in 2008. And, if you were an American in 2008, you were just watched the value of your biggest asset get cratered because of scamsters in the existing traditional finance industry, right? To just point at us and go, you guys are all criminals is ridiculous. Like, the regulations exist because, right, criminality has been rampant in the traditional finance industry forever, right? Whether it's the central bank shaving, causing inflation by reducing the amount of silver and coinage, or whether it's the stock market, being pumped and dumped in the 20s, or whether it's the S&L crisis of the 80s, or whether it's the real estate crisis of 2008. There is huge, massive institutional fraud within the traditional finance industry, and the cryptocurrency industry is no different in that regard. It's the same kind of thing. The laws are already on the books, just enforce them.
It's entirely different. Nobody who has money in a federally insured deposit account has lost money since those funds were created back in the Depression. Go talk to the people who were the customers of Celsius Networks, all 1.7 million of them. That's just one. There are others that are a similar type of business. They have also gone bankrupt. And the news, the most common news I'm seeing in the papers these days is hundreds of those people sending letters to the bankruptcy court saying, I have to have access to that money. I live on that money. I'm going bankrupt myself. I'm going to be foreclosed on my mortgage. I can't buy food because I have no access to that money. And they don't have access to that money because that crypto bank was not regulated as a bank. It's the development side.
It was already, look, if it was a bank, it was already regulated under existing laws.
It was not.
The fact that federal regulators don't know how.
Celsius Networks was not regulated. It was not regulated.
Can I ask a question? We're going all over this. I think originally we were supposed to sit here, you tell us why we're supposed to invest as a bank. We're totally off that base, right? It's pretty good. So as I hear, there's two options for banks. And again, white-haired bald guy, okay? So I know enough to be dangerous. First part is currency processing, right? So should banks be involved in currency processing? This is no different than credit cards. At some point, if I have enough of my customers that want to be involved in cryptocurrency, and they want me to process this stuff so they can convert it into currency, sure, I can do that as a bank. I have no risk, right? I charge a fee just like credit card processing. Let's put all that aside. Let's go to the investing part now, the other half that we're supposed to be talking about. So I'm a CFO of a bank or a treasurer, right? I got $100 million to invest. Let's be honest, when we invest, that's nothing more than trust. When I buy a security, it's nothing more than trust. Even if there's collateral behind it, even if there's regulatory oversight over it, I'm investing the money based on trust that I'll get my return and I'll get my money. So convince me as the CFO of a bank that I can trust enough to invest in cryptocurrency today.
That's a good point. Do you think, and do our panelists think that banks have the systems to be able to establish there's enough trust in certain currencies? And let's not talk about the industry as a whole. Let's talk about maybe what would be considered the standard cryptocurrencies, or even new ones that could become standards. Would a bank have the tools to be able to evaluate whether they could make investments or they could hold collateral or something like that in relation to investments that the bank makes?
Well, again, let's distinguish between investing and money. And Ray, you're going to investing. Mm-hmm. And I would think any bank that would invest in cryptocurrency is going to be very ripe for regulators to come in and just beat the hell out of them. That is, it's irresponsible.
As an industrial bank, we used to get the crap beat about us, but I'd love to hear from these two.
I mean, generally speaking,
I want to hear what's in the other boat.
yeah, right. So generally speaking, if you have large stacks of cash, you want a diversified portfolio where some of it's invested in things that have low risk and low return, and some of it's invested in high risk assets that that may have outsized returns but may also decline in value, right? And the question is, given the literally thousands of crypto projects that you could potentially invest your money in. If you're going to select one, how do you categorize its risk? And frankly, like, there are a lot of projects for which that simply cannot be effectively done. And I wouldn't encourage you to put your money in those. But the flip side of that is that there are a lot of extremely legitimate projects that don't have that problem, and that if you investigate them, you can, hey, look, this is actually, a company that's run here in the U.S., and if I buy their tokens, it's backed by some commodity or some, whatever future promise of a commodity that they're going to try to go after, and so this project looks reasonable, and the reporting is good, and their prospectus looks reasonable, and that kind of thing. I think that's the same kind of risk assessment function that you're doing with any security that you're purchasing off the stock market or the commodities exchange or wherever else you're putting your money.
I think that's key to understand, is that most of these are going to be seen as securities. I cannot, honestly, I look at, and I'm not aware of every cryptocurrency out there because there are thousands of them, but Bitcoin is the only one that I would say very confidently that the SEC is not going to regulate as something other than a commodity. And so you would have to view it as a security, and the same due diligence that you would do to investigate whether you would invest it in any other security. Now, with a lot of those securities or IPOs, you are getting more information, and you're having financial disclosures quarterly, and with some of these cryptocurrencies, that is the concern, and that is a risk. But from a regulatory standpoint, to George's point, I think that is a risk going forward with these cryptocurrencies. If they are deemed to be securities later by the SEC, they're likely going to be in violation of securities laws.
There's still some permissibility concerns about whether banks can own crypto assets because of that reason, because we consider it securities.
Yeah.
Oh, yeah.
Most crypto projects, let's be clear, most crypto projects and ICOs, for example, token offerings, are not issued in the United States, and they're not issued by Americans because they are explicitly trying to avoid SEC regulation. And so to the extent that they're available to individuals through US exchanges, they're only available under the existing regulatory framework that securities are sold under.
Maybe I should ask a panel question. What do you guys think about tokenized deposits versus stable coins? I mean, I think there's been a lot of discussion about exporting tokenized deposits and what that would do to cryptocurrencies or digital assets. That's what we were going to say, digital assets.
Well, let me go back to my position as the director of a bank. I came to the conclusion we didn't want to have anything whatsoever to do with it because I would not want to be associated with encouraging in any way somebody to buy a crypto token and deposit it in the bank. Because it is so volatile and because of such a huge risk that they're going to deposit it at a value of $68,000 one day, and a few months later, that deposit's going to be worth $23,000. It does not work, and people get hurt. They get hurt badly by those kind of economic gyrations. The inflation we're seeing with the US dollar is nothing compared with the volatility of a cryptocurrency. Let me go back to Ray's question. I think anybody who's competent, who is investing in something, would look at a cryptocurrency and say, what am I investing in? It's a bit of software that has no value whatsoever, except what people buying it back and forth put on it. So, and that's
the US dollar, what value does the US dollar have if it's not backed by gold 1-to-1 anymore?
It has the social contract.
And it's not social contract when someone buys a Bitcoin for what they agree on?
No, there's no social contract that says if I'm selling something, you can bring a Bitcoin to me and pay for it, and I'm going to accept it.
I think we've got about 5 minutes left here. So I think with those 5 minutes, what I'd like to do is ask final question. What's next for banks' involvement in cryptocurrency? What happens in the next maybe 12 to 18 months that could develop the adoption of either the adoption or the death of cryptocurrency involved in banking?
I think I'll probably do the most boring answer, so I'll start and then Dave. But I think that banks will be able to, I think they likely move forward to adopting blockchain technologies, meaning a decentralized ledger system. A lot of the time, I imagine they will want to do it themselves and to create their own tokens that are backed by their own currency that they have in their banks of US dollars. And by having a decentralized system that they'll have greater security and because Bitcoin has never been, I don't think it's ever been hacked in history. And there have been, and a centralized ledger is easier to hack. So I think banks will get into this, and I think there's a future in cryptocurrency, and I imagine that as regulations come forward, there will be a lot of institutional investors stepping into the game and from the sideline.
Well, I think, again, let's divide this up into the development and the investment side. On the development side, there very well could be some things in development that would turn out to be very safe payment systems or other financial systems that would include a kind of crypto money. So the value would be brought into the system, converted into that, make its way through the system, be convertible back to dollars. Stuff like that may work fine. The only problem is we haven't seen it yet. That doesn't mean it isn't coming. And I'm certainly no specialist in that area. On the investment side, on the private money, I mean, that's what we're really talking about here is private money. On the unregulated private money side, I think the federal government is going to have to put an end to it to the extent it has any success in becoming a form of currency in the broader economy. It's just, it doesn't work as money, and people are going to get hurt the more it is used in that sphere, and the crime has to be brought under control.
Nash?
Yeah, 18 months is a pretty short timeline. I think if I was going to give one piece of advice to bankers, it would be to hire somebody who's crypto native, who can, work with you guys to understand what the risk management strategies for a bank really are and how to interpret crypto assets in a way that can, that banks can make sense of those assets in terms of their risk management strategy. That's what I would be focused on for the next year and a half, would be just understanding what's going on, because it's a very rapidly changing environment. There's a wide variety of products that are available beyond just the layer one cryptocurrencies. And understanding it, I think, is the first step. If you want to invest $100 million, you have to know what you're investing in and why it makes sense to invest in it. But that said, if you sold Bitcoin at the top, if you bought it 5 years ago, your returns would have been 1,500%. It's the only asset in the entire world that has outperformed the Federal Reserve's balance sheet over the last decade. And to ignore that and pretend that there's no value in those kinds of returns is, I think, an unfortunate position. And people who stick to that, I think, are going to miss out on the next revolution in financial industry.
All right, that's our panel, guys. Thanks for coming.